I was trying to like pick out which Porsche I was going to buy after this one.
Yeah.
So the very first deal I did was really, really great timing. It was June of 2022. I had actually bought 3X NASDAQ back in like 2019, and I diamond handed that right through the drop in 2020. It's down like 80%, and I didn't even consider selling.
What led you to participate?
Tip alert, AI is pretty helpful for these things. Plugging things like your K1 into an AI, I like to use Claude Sonnet. I knew the deal was pretty much underwater before they ever did the capital call. I don't feel like I can take what's worked in the last 30 years to the bank. So that's probably my number one lesson, which is how massively important interest rates were.
The views expressed in this podcast are those of the individual guests and do not reflect the opinions or recommendations of Invest Clearly. This podcast is for informational purposes only and should not be considered investment advice. The appearance of a sponsor or investor on this show does not constitute an endorsement or a warning. Invest Clearly is an objective and neutral platform. Always do your own due diligence before making any investment decisions. All right, awesome. David, thank you so much for joining me. It's really cool. I think you were the first person that I've ever actually connected with in real life off Twitter. So it's cool to have you join me. Yeah.
And I'm glad to be on here.
Awesome. Good stuff. Yeah. But before we get started, why don't you take about 30 seconds, tell us what you do and we can get rocking from there.
Yeah. So I'm an orthodontist by trade. I actually started my career in the Army. It turns out that you can get your dental school paid for if you do an Army scholarship. So, I was on an Army scholarship through dental school there. And then when I got out of the Army, I started up a practice. I work with partners. We're part of a group called Celebrate Dental Embraces. And so we, build a network of clinics. And I just have fun doing braces and then building dental clinics.
That's awesome. And for what it's worth, I following you on Twitter, I never thought I'd know as much as I do about the dental and orthodontist space. So it's pretty cool. Yeah. Now, are you do you own your own practice? Is it like one location, multiple locations, or
Yeah, so I own a practice with Celebrate Dental Embraces. That's sort of our specialty. Basically, is all the people in the organization in their own practices. So I'm a business owner. We have one location that we started up 4 years ago. And then we're starting a second location here in Austin, Texas. I'm in Austin. So we're starting the second location in this coming summer. So we're excited about that.
Great stuff. And then your journey into like passive investing, did that start just to pursue some supplemental income? Was the goal to at some point be an investor full time, or how does that work?
Yeah, so my story is I actually started investing when I was 15. So my mom was listening to this radio personality who was into financial stuff called Clark Howard on the radio in Georgia back in the day. He was telling people, hey, you should just invest passively in the S&P 500. And so I owned a lawn mowing business with my brothers. It was actually pretty legit. We had 70 customers our best summer. So it wasn't just us with a push mower. We had good equipment and everything. So I was making money and started investing. And so that was the beginning of my career. And this is, in the 2000s. So I kind of was right after the 2000 crash, then survived the, 2009 crash. So had some bear markets, some bull markets in investing. Yeah. I just found it fascinating. I enjoyed it. And then once I got into business ownership, my first introduction to kind of LP or syndications was through a business partner who had been doing some multifamily syndications and introduced me to my first deal that I ended up doing. So that was, and really the driving force behind it was diversification. So definitely believe in diversification. And, the returns look pretty impressive as well. So I was, kind of like, okay, well, if I'm in the S&P 500, maybe I make 8 or 10 or 12% a year. But the hope was definitely to make a higher return, maybe doing some of these syndications and everything.
Yeah, that's great stuff. So when was that? When was like your first syndication?
Yeah.
deal?
So the very first deal I did was really, really great timing. It was June of 2022. It was a multifamily value add deal in the Irving area of Dallas. The sponsor has a really good track record. So we can talk more about that deal, but unfortunately my timing was pretty bad to dip my toe in the water there.
A lot of people are saying the same thing. Unfortunately, it's tough, but
yeah.
I'd love to know, tell us a little bit about your portfolio. You mentioned multifamily. Mm-hmm. Are you strictly in multifamily? Are you diversified across asset classes? What does that look like?
Yeah. So, what I'm really hoping is I know that there's a lot of people that are just like me out there, that there's doctors, lawyers, dentists, other just high income professionals that they want to diversify, sort of the same story I was telling you there. But maybe our background isn't in real estate. And so you're stuck with this decision. Do I just stay on the sidelines, or do I find some way to gradually get into these syndication deals? And there could be all sorts of different motivations and strategies that people have. So I guess as I'm saying that, what I'm trying to say is I'm still not an expert, my day job is making people's teeth straight. I've probably made as many mistakes as I've made any sort of good decisions. But hopefully, kind of in talking about it, somebody else who's in my shoes that wants to get into LP investing, wants to get into real estate syndications, can learn some stuff, maybe get some confidence to get going with it, and maybe learn a few things to avoid some of my mistakes. But right now, I've got 4 real estate LP deals going at this point that I bought, the first in 2022, the next 2 in 2024, and then the latest one just a few months ago here in 2025. So we can go down the list there if we want to talk about each one or however you want to go about that.
Yeah, that'd be great. And I'd love to learn, about the deal, but also the experience of each one. How are they currently performing? And you mentioned mistakes as well as successes, and kind of walk us through that along the way.
Right. So the first deal, like I said, Irving in Dallas, an experienced sponsor, was putting out some pretty impressive returns, and a business partner introduced me to this group and vouched for them and stuff. And so I kind of felt like, hey, it's now or never. Let's just dive in. I thought that hopefully it could be really cool, but I also knew that maybe it wouldn't be, because I was still inexperienced and everything. And I was looking back as I was preparing for this, I was looking back through the pitch deck for this. And, just Dallas was crushing it at that point. They were showing 8.6% rent growth year over year. I think in the time leading right up to this, it had been even higher than that. Cap rates had been compressing over the last few years. So people were just really crushing it in these value add multifamily deals in that, 2020, 2021, early 2022 as well. And so this was supposed to be a value add 2 to 3 year hold. The cap rates were really low. I'm looking at it. I think they were saying it was 3.75% cap rates in that area at the time. And so they were trying to be conservative. So as they were projecting, exits and stuff, they're like, let's be conservative. Maybe we'll project a 4.5% cap rate, exit and show you that it still works at that point. Well, the problem is the cap rates went up even more than that. So this deal, the cycle on it is this sponsor has done an incredible job of communicating. We constantly get updates. Very detailed updates. And so the whole time I've actually been very well educated on what's going on with this deal because they've done such a good job with communication. And so what happened is they hit a perfect storm on this one. I was looking back through the pitch deck. It looked like they did a very thorough job on investigating the market, comps, competition, what was going on with rent in the area and what ended up happening. I don't know if this was something they could have known, but the market really got flooded a little bit with new supply. And then also the whole area, a lot of the other apartments in the area started struggling with vacancy. And so everybody started offering rent discounts, so here they are projecting rents to climb organically. Plus they were planning on pushing them with their value add. It ended up being that they spent a lot of money on value add trying to improve the units and stuff, and the rents have barely budged from when they bought it. If anything, they may have gone down. I can't remember for sure. So, you got rent growth not keeping up with their budgets. I think as I've been seeing it, they're like 30 to 40% behind budget on rent growth.
Boy.
So the NOI hasn't really built the way they want it to. And then obviously the other part is your interest rates and your cap rates, which are related. And so big lesson. Okay. So, big lesson. Interest rates matter. Okay. So that maybe that is like the number one thing I've learned on this real estate stuff is I have a personal belief now that just this massive secular kind of bull trend basically in interest rates starting in the 80s with really, really high interest rates and then just gradually going down over, an entire 30-year period. Like boomer investors and stuff didn't know anything but a gradually falling interest rate environments. So their bond portfolios, everything they knew about bond investing was influenced by this massive 30-year bull run, in dropping interest rates. Real estate investing, massively influenced by it. So I don't know what the future is going to look like, but I just know that I don't feel like I can take what's worked in the last 30 years to the bank for what's going to happen and work in the next 30 years. So that's probably my number one lesson, that I've learned from this deal is just how massively important interest rates were. Because we asked, people knew that interest rates were going up. We knew inflation was happening. I remember vividly actually on this, it was my very first deal. So I remember the discussion, during the talk with the sponsor there, and people were like, hey, we're having inflation. How's your deal going to do if there's inflation? he's like, don't worry about it. Rents will grow. Like if inflation grows, rent grows. You're actually hedged. It's a hedge against inflation. Yeah. And like, hey, like interest rates are going to go up. And this is one where I think honestly, nobody expected them to go up as much as they did or as fast as they did, because they tried to be prepared. They had a great rate cap that they had bought. They had several years of runway. Like I don't think they were irresponsible in their interest rate, stuff. But I don't know if they underestimated or I underestimated how much interest rates would just absolutely blow cap rates up. I think it was like, okay, well, we're not going to get killed with debt service. Yeah, but you're not going to get the cap rate once those interest rates change. So that was some stuff that I learned from that deal. So the really good part of it is that they've communicated really, really well. The bad part of it, is that, that deal honestly may be underwater right now from everything I can tell. So they just had a capital call this summer. It wasn't a big one, so it was 5%. So I didn't have to put much money. I did participate in the capital call. And basically what they're trying to do is they're trying to buy enough of a rate cap to try to ride the storm out here, finish stabilizing the property. And instead of trying to do a quick flip, 2 to 3 year value add, super high, return multiple, they're really just trying to salvage investor capital, try to cash flow it for a little while and see if they can, get people's money back and maybe manage to get some sort of minimal return along the way as well. So they're trying to transition to holding the property a little bit longer and cash flowing it.
Yeah, that's very interesting. Let me ask you this. I'd like to dive down in a couple different areas. So first of all, with the capital call, what led you to participate? Was it confidence in the next tier of the business plan, or was it sort of like, hey, I'm in this for this, I might as well push a little further? So like what other option do I have sort of situation?
Yeah, great question. So, I think the communication did build some confidence for sure. So if it was, I'll talk about some of these deals later on that I've gotten very little communication. If all of a sudden they came asking for a capital call, I think the decision would be harder. But there's been very transparent communication. Like I knew 2 years ago that the deal was struggling. One other little tip. Okay. So tip alert, AI is pretty helpful for these things. So, if you've got some numbers from your deal and they haven't really told you like where you might be at, plugging things like your K1 into an AI, I like to use Claude Sonnet. So plugging your K1 in and then any other information that you might have about the market environment, like NOI numbers, stuff like that. A lot of times you can plug it into AI. Take it with a grain of salt. AI makes up stuff all the time. But I think you can often get a pretty decent feel for where your deal is at if you yell and beat the AI on the head a little bit for the dumb stuff it tells you back. But combination of good communication from them plus some AI tools, I knew the deal was like pretty much underwater before they ever did the capital call. So good communication was part of it. To me, it felt like a little bit of like an asymmetric bet on doing the capital call. It was a fairly small amount. And so it was like, hey, if I and the other LPs in this deal put just a little bit more money in, there's sort of this asymmetric risk that we might be able to get most of our investment back for a very small additional amount of money versus if we don't participate, it's all gone. Like they're just going to get forced liquidated basically. So I think that was what gave me the confidence to do it. It was a small capital call, clearly outlined what they were using for, transparent communication, and then it seemed like for a small amount of money, we got a chance of maybe getting a large amount back if we were able to save the deal.
Yeah, that's good to know. And how long did it take you to get to that confidence? And I'll explain what I mean, because capital calls are not fun. I don't, we've been in an industry where obviously there's a negative connotation on it. Like, it's never really happened in the past. Oftentimes it's the best lever to pull in the situation that you have, but there's this like negative cloud around it in general. And so when you got that notification, it was like, okay, we're doing a capital call. You can participate. Here's the outcome. You cannot participate. Here's the outcome. How long did it take you to get confident in that, right? You mentioned the communication, and then you mentioned using the tiers of AI. Was it like, okay, this makes sense? Or was it like an internal battle of emotion versus logic? And I'm asking this from the perspective of the LPs that are likely facing this, that are listening to this and have never even thought about this in the past, because I've talked to so many people that are in these situations and it's like unfathomable to them. So I'm trying to say, hey, this is how you think about this emotionally, but also logically.
Yeah. I think knowing your own risk tolerance, and your own investing personality, I guess, is very important for making these decisions, because there's all sorts of different people with different goals in the LP space. So you might have a 65-year-old doctor who is actually worried that the stock market is too volatile for them, that's they feel real estate is a safe bet or something. And so they've invested in something that was supposed to cash flow, and then all of a sudden it's underwater. They've halted distributions and they're about to lose the property. And so you're getting a capital call, for this investment that you thought was more of a safe bet or something. So you got that on one side. On the other side, you got other people. This deal was fairly aggressive. I was looking at they were projecting optimistically a 44% return, and pessimistically a 30% return on this one. So I was trying to pick out which Porsche I was going to buy after this one. Yeah. But so for me, my risk tolerance is super high. I'm young, I'm at the height of my income producing years basically. So I got cash flow coming in. I'm not relying on this for any sort of income. There wasn't supposed to be any distributions from this. It was purely, buy, flip, sell. And then, I invest in crypto, so after you've invested in crypto, losses and other investments, you're just numb to it basically. So I think people's personal risk tolerance, it's these moments, if you're in stocks and, there's a bear market, it's a 30, 40, 50% drop or something, you find out what you're really made of. Basically, you're in crypto, you have a 90% drop in something, you find out what you're really made of. Once again, I don't know if I recommend this to anybody, but I had actually bought 3X NASDAQ back in 2019, and I diamond handed that right through the drop in 2020. It didn't even flinch, so it's down 80%, at the base in 2020, and I didn't even consider selling. And then now it's up it's done really, really well, 30, 40% returns over the last 6-7 year annualized. So all that to say, I have a super high risk tolerance. And so the idea of losing all the money, okay, well that stinks, but it's not the end of the world. And so I guess there wasn't very much emotional turmoil from it. It was okay, well, maybe I lost my money. And then what's the best decision moving forward here? So I think I was able to kind of remove any sort of emotional component from it there. It was actually a pretty quick, easy decision. At that point, it was okay, for a minimal amount of money, I may be able to save this investment and end up getting the money back, 2, 3, 4 years from now.
Yeah, that's awesome. And it's so funny you bring up the crypto risk tolerance versus this. I feel in this world, it's I'm the LP defender. And then in my crypto portfolio, I'm we're taking this thing to the ground, or we're taking this thing home. You know what I mean? So it's two different personality types, which is pretty funny. So you mentioned a couple other deals you're in as well that came after this one. Tell us a little bit about those.
Yeah. So the next one that I invested in was June of 2024, and this was an RV park. It was new development.
Now, David, let me ask you this. Sorry, before you jump into what, any particular reason why there was a 2-year gap, or is it just the deal didn't come that penciled?
Yeah, great question. So I had just started my practice in the fall of 2021. So in one sense, it was a little bit of a stretch even making that first investment in 2022 because the practice wasn't making much money. In fact, in June of 2022, my practice would have been nearly breaking even. So it was a little bit aggressive of me to even invest in that at all. And so I kind of hit the brakes on any big new investments for a little while the practice was growing. It was kind of stretching me just to even try to max out retirement accounts that were available and stuff like that because the practice was new. So especially an orthodontic startup, you don't make a whole lot of money right at the beginning. Typically you're lucky if you're just breaking even for the first 6 to 12 months, and maybe you're writing yourself some. So I think I wrote myself my first paycheck in August of 2022 from the practice. Yeah. Now I had sort of a side gig that was making some income also. But yeah, I just didn't have the money coming in that sort of 2023 timeframe because I was plowing most of the available capital into retirement accounts and stuff like that.
Got it. Okay.
Yeah.
Just curious.
So yeah, June of 2024, I finally got some money again. Do this RV park development. This one, I'd interacted with the sponsor on Twitter. So another investment belief I have after, my long, lengthy 3-year career in LP investing here is that the sponsor matters a ton. So I feel pretty confident in this recommendation. You need to evaluate the deal, but at the end of the day, the sponsor matters a massive amount. So, make sure you have confidence in the sponsor. So I, interacted, been sort of watching from the sidelines, this sponsor, kind of go about their business on Twitter and everything. Now, caution, more and more you realize that if you're on some sort of a social media, be wary of influencers, like try to actually make sure that you aren't kind of being taken by an influencer. An example of this actually is I do feel like there's kind of like an investment group that caters to doctors. I get their newsletter and stuff like that.
Yep, I was going to ask you about this.
I've actually lost confidence in them because I felt like they were pushing bad deals with very little disclosure. There was a sponsor group that was also underwater on a lot of their deals. It was struggling financially, just the group itself. And their strategy was to just sort of try to buy their way out of it, So they started trying to just buy a bunch of deals once the market was distressed in 2023, 2024. And they were trying to just make enough money. This is my take on it. They were trying to make enough money from kind of GP fees and, just acquisition fees and stuff like that to bail out their other deals. And so there was very, very little disclosure of that from this group that's, sort of recommending stuff to doctors and everything. And that kind of left a bad taste in my mouth. Those deals may work out great. Like they may be successful for all I know, but I feel like if you're an influencer and you're trying to market deals and stuff like that, you owe it to me to give me the good, bad, and the ugly. Like let the sponsor kind of pump the sunshine and roses and stuff like that. Like you got to give me the straight scoop. And I especially, you want to be aware of maybe if there's some sort of influencer who's being financially compensated. I don't know if this newsletter is being financially compensated. I have a feeling they are, but I'm not sure. But yeah, I feel like there should have been more disclosure with that because you should kind of go into those deals with your eyes open that, that there's these risks with the sponsor. And we feel like they're getting good deals. They're getting distressed properties, if they're able to raise the money, despite, some headwinds in the market here, these could all work out really, really well. But I should at least know, I should be able to count on you to give me better research than I could have gotten on my own.
Yeah.
So yeah, maybe a long-winded way of saying, be careful with influencers on social media, make sure they're the real deal. So this one, RV park development in Nashville, ground up. They're projecting 35% returns on this one. Any sort of new development's going to be higher risk, higher reward. This is one of the ones I haven't really gotten much communication on. So honestly, I don't really know too much how it's doing.
Yeah. Oh, geez. So let me ask you this: how do you balance that as an LP? Most of the people I talked about, it's all about communication. Like I always say, like obviously no one's excited to take a bath in their investment, but when I talk to LPs that are losing money and don't hear from the GPs, they'll talk about the loss of capital for about 5 seconds, and then the rest of the time talk about that they're not communicating. So like you had the experience with the first GP where, probably not, they're underperforming, but they're communicating, and now you have another GP where you don't know if it's doing well, but they're not communicating. Like, how do you balance those two experiences? Like, is it like, hey, even though this went poorly, or I know for a fact it's going poorly, at least I'm informed that it's going poorly, and therefore I'm, more okay with that versus I have no idea over here.
Yeah. I think that's where going full cycle on a deal is super important because, I'm going to forgive a lot of communication errors,
if you get your money back. Yeah.
So if 2-3 years from now, they send me a big check for a 35% return year over year, I'd be pretty tempted to give them some more money, despite any sort of communication. I mean, the point is to be passive. Like, so if if based on your track record and the deals I've done with you, you're performing and making money, like that's all that matters in the end. That would make a big difference to me. But yeah, it's going to take more to build trust for that next deal if I haven't gotten solid communication, than somebody who both communicates well and crushes it.
Sure. And are you reaching out to this individual and they're not responding? Or is it just like, hey, the automated communication out of their investor portal isn't scheduled and it's not coming? Like, what is that disconnect like?
Yeah. So I'm, not necessarily actively trying to hunt them down and they're not responding.
Just curious,
once again, I got a practice to run. Like, I'm not going to be hounding you for information. Like, I need, I need you to kind of just send me an email, send me, a portal that's easy to use or something. And that, once again, it's possible that I'm falling down on the job and there's like some good information on the investment portal, but maybe just, a little bit more, clear directions maybe on how to access that. I'm pretty sure it's not there. I mean, I've been on their investment portal and stuff like that. I've tried to look some, but it's not like I've been hounding them for information.
Yeah. Well, that's not why you got into this, right? Like it's simple as that, like you said. Okay. And then before we started recording, you were telling me about a unique deal that you're in that's not necessarily traditional real estate that you wanted to talk about, which is really cool because I think a lot of our listeners are also diversifying into, small business and which is like, traditional private equity. And so I'd love to hear a little bit about that.
Right. Yeah. So once again, we mentioned that about Twitter. Okay. So just to explain a little bit more, because you probably got listeners from all over. Twitter is an interesting animal. Okay. So you can get on Twitter and argue about politics. You can like look at stuff about anime. Whatever you're interested in, sports, it is on there. But it'll drag you into, the algorithm just wants to show you what you pay attention to. So if you're kind of undisciplined about it, Twitter will start showing you stuff that you care about. So yeah, like maybe you kind of you can get rage baited about politics and there's some sort of political thing that goes on there and you're like, just firing off angry comments to somebody you disagree with or something. Man, Twitter's going to show you all sorts of politics.
It's the Wild West.
So with Twitter, I got on there and I realized that there was an entire thriving community of real estate people. Yeah, there's an entire community of people sharing information about LP investments. There's an entire small business community. There's an entire community of people doing acquisitions and stuff like that. And so I decided to get on there and just post about dental business. So I don't talk about the actual clinical side. That's boring to most people. I just talk about the business of dentistry, basically. I just try to be disciplined to provide content, useful information, kind of geared towards maybe a dentist who owns a practice, a young dentist who wants to own a practice, or generalized business stuff that could be hopefully relevant to anybody. Managing your team, managing your finances, just the operations of business, that's universal. Like an HVAC owner, hopefully might learn something from my content, we all have to get reviews. And so, there's this whole community. And so I've gotten connected with a lot of people from Twitter. It's almost like back in the day, if you went to the country club and met cool people doing cool things that have money and everything, and then you realize you can work together, you're out playing golf. Yeah. It's the same thing without having to play golf. And so basically I met a guy who does trade schools. So his whole thing is he knows how to do trade schools, HVAC trade schools, plumbing trade schools. And then I met another guy who actually wanted to be the operator. There's a joke on Twitter, like, just buy a business, put an operator in it.
Yeah. Easy.
He wants to operate. So all of a sudden you have a dentist, a trade school guy, and a guy who wants to operate. And we all kind of put our heads together, like, let's do a business together. So we've built a dental front desk trade school. So like the administrative portion of dentistry. There's a lot of dental assisting, the hands-on. So if you think about, you go to the dentist, the person who helps the dentist, there's all sorts of schools for that. But the front desk type of stuff with your insurance, your scheduling, your administration, there's not really too much for that. So we're trying to make it AI, online enabled, and do a trade school for dental administration. So
that's cool.
So basically I supplied all the capital for that. So I made it's kind of a passive investment. I supplied the capital to get it going for a 30% stake in the company there. Now I have a lot of expertise in the field. So technically, according to operating agreements, I'm a passive partner. I don't have to do anything, but I'm a 30% equity owner in it. So I want it to be successful. And so I've been trying to lend any sort of expertise on marketing, the dental side of things, connections, networking that I can. And so that's where, as an LP, if you want to take one further step, if there is some sort of area of expertise that you have, sometimes you can be a little bit more than just an LP. The analogy to this that people, if they're researching this type of field, is small business acquisitions. So there's an entire thriving community of small business acquisitions, people who want to buy a small business. And the way it typically works is the bank will supply through SBA loans the majority of the money to buy a business. But then a lot of times there's still a pretty decent down payment that's needed. And so if somebody wants to buy a business and they don't have that entire down payment just in cash themselves, they can bring on an investor to supply that down payment. And a lot of times you can get a passive investment in a small business. So you could literally sort of fund somebody to buy a plumbing business or an HVAC business or something like that. And maybe you would, for this, typically you'd be putting a pretty sizable amount of money into it. But I mean, the amounts could vary, and you might get maybe 10% or 5% of the company. It varies a lot, but that's the basic idea behind being sort of an LP in small business acquisitions. And so with that, you would really want to make sure you actually had some sort of ability to vet those deals, vet the sponsor, like really have something that you believe in, because the operator is almost the entire thing in a small business like that. So that was that was my foray into small business passive investing there.
Yeah, that's fantastic. Yeah, what a cool story. And again, that's more than likely where we will end up in the future, and from an expansion standpoint. So it's really cool to talk about. Now, David, we're nearing the end of the call. I'd love to ask you the question, my favorite question that I ask in every call. What part of passive investing do you think needs to die?
Yeah, I touched on it a little bit. I definitely think any sort of deceptive, like influencer type of marketing of, LP types of deals. So, unrealistic expectations. That type of stuff of kind of recruiting people for these passive investments, kind of maybe preying on dumb money, I guess. Yeah. And I guess maybe as a doctor, we're sort of the stereotype of dumb money. Like, hey, go see if you can get some dumb doctors to invest with you type of thing. It's maybe that's near and dear to my heart is protecting dumb doctors from losing their money in LP investments. Yeah.
I'm with you. I when we first started this, I used to tell everybody the reason we got into this was because we're firm believers that like social influence is not social proof. Like this is charisma and it's marketing, and you need to invest in real estate operators, not marketers who are doing real estate. So I'm with you 100%. Awesome, David. Thank you so much for doing this. I know we were talking about it for a while, and I'm really excited that you came on board. This was an awesome call. You really detailed, and I think the listeners are going to get a lot of value out of it. If people want to follow along with you, we talked about Twitter a lot. How would they get in contact with you?
Yeah, so my handle on Twitter is @the_DSO_guy. So you could search for @the_DSO_guy, and hopefully there's some good content for you there. I guess maybe the final thought I'd leave everybody with is, I've kind of shared some hopefully some wins, hopefully some, maybe not some too big losses, but my thought is that you use this as tuition in the school of hard knocks. Basically, if you just dive in sometimes with an amount of money that is responsible for you to put at risk with something that you're not quite as familiar with, at that point, now you can actually start learning. Okay. So I actually, read some books. We've got The Lifestyle Investor here. That's a good one. And then The Hands-Off Investor is very specifically about, that's by Brian Burke, about LP investing. And so now, because I got money on the line, I can actually force myself to read a dry book about NOIs and cap rates and stuff like that. Eventually you start actually learning what you're talking about. I'm still trying to figure out some of these things, but once you actually have some money at stake, it's a lot easier to truly discipline yourself to go in there and learn, so you're not dumb money anymore. So that's what I would encourage people to do is if you think you want to jump in, put amount of money at risk that you're comfortable losing, maybe do your due diligence, but then use that as an opportunity to motivate yourself to learn.
That's awesome. Yeah, the acronyms and the financial numbers are endless. So that's good. David, thank you so much. This is great.
All right, awesome. Good talking to you.
Thanks for listening to the Invest Clearly podcast. To find verified investor reviews or to claim your GP profile, please visit investclearly.com. If you enjoyed this episode, please remember to like, subscribe, and leave a review, because that's how other people find the show. Till next time, invest clearly.